Hello there. Hello there. I'd love to thank you for joining me for this awesome presentation. My name's Lucy Forex, as you can see right here, and I'm here to talk to you about the following topic: the forex market and economic indicators. Now, before I go on, allow me to thank my mentors, Robert Kiyosaki, who wrote the book Rich Dad Poor Dad, Timothy Sykes, who wrote the foreword to the book of the Penny Stock Course. Also, I'd love to thank Matthew Crater, who wrote the book Rocket Stocks. So now let's dive into this. So we're here to talk about the forex market and economic indicators. Now, the forex market is a vast global marketplace where currencies are traded. Economic indicators are some of the most influential factors that drive the forex market. So you need to know that it is important to understand economic indicators when trading the forex market. Now, the importance of forex market. Now, there are three important things about the forex market. Number one is liquidity. Number two is accessibility, and then number three is profitability. So, let's start with liquidity. Now, the forex market is the largest and most liquid financial market in the world, and this is why I love forex. It's very liquid. It's over $1 trillion daily. So the forex market is so liquid that you can literally save your entire capital in it. Accessibility. Now trading in the forex market is open 24/5. All right. So that not including like holidays, weekends basically. So it's offline from Saturdays on Saturdays and Sundays. It's kind of offline. So you can trade it anywhere from anywhere in the world. You can trade forex from anywhere in the world, and that's why I love forex. And it's got online brokers. All right, and then the final thing is profitability. So the forex market provides ample opportunities for traders to make profit. Yeah, so it's basically called hedging, right? So you can hedge your capital in the forex market. And of course, allow me to mention that at the end of the presentation, I will show you a demonstration of the rocket booster strategy on the Forex market. But for now, let's look at the four major players in Forex market. Okay, the four major players in Forex market. All right, so who are these four major players in forex market? Number one is the central banks. So central banks, number two, commercial banks, number three, hedge funds, and number four, retail traders. Like myself, I'm a retail trader. So central banks play an important role in the forex market by managing their country's monetary policies, exchanging currencies, and maintaining exchange rate stability. Number two, commercial banks. Commercial banks participate in the forex market to facilitate foreign trade and manage currency risks. Number three are hedge funds. Hedge funds are active participants in the forex market due to its high liquidity and volatility, volatility, right? And these hedge funds, they use strategies and that take advantage of market moves. So I also want you to take note of like commercial banks. Commercial banks facilitate foreign trade. So you need to understand that being part of the forex market, you are part of these major players, and the last one is the retail trader. So here it says retail traders are individual traders who participate in the forex market through online brokers, and they trade currencies for speculation to hedge their investment portfolios. So who are you amongst these four major players, right? I personally am a retail trader, all right, and I basically hedge the capitals through the forex market. Of course, you remember that they're hedge funds. I think that was last month. I was trying to open a forex account with a commercial bank, and the commercial bank had a threshold, and that threshold was only for hedge funds. So there are some commercial banks, probably in your nearby city or country, that offer forex trading only to hedge funds. But the good news is there are online brokers that offer forex trading to retail traders like myself. So, what are the factors influencing the forex markets? So, there are four factors that influence the forex market. The first thing is the political events, all right. And then the second thing is the monetary policies, okay. And then the third thing is the market sentiment. Now, the market sentiment is basically comes from market analysis. So let's say on the current trading day, who's trading what and where on that current trading day. And it's very important to remember that. And finally, the economic indicators. Yes, economic indicators do influence the forex market, and it's very important for you to know the right economic indicators to follow. Let's see. Also, if you're enjoying this content, by the way, please rocket boost the video to inspire me and encourage me so that I could share more of this education with you. Rocket boost this video and leave a positive comment if you can to inspire me and encourage me to continue sharing this knowledge with you. So, an overview of economic indicators, which was one of the four factors influencing the forex market. So, the four overviews of economic indicators. So the first one is the GDP. So GDP stands for gross domestic product and is a measure of a country's economic output and overall health. It reflects the aggregate value of goods and services produced in a country over a period of time. So GDP is basically the health of the country's economy. It's more of like the cash flow, right? Inflation is the measure of the rate at which prices of goods and services are increasing. So higher inflation tends to depreciate a currency's value. So the rate at which the prices of goods and services are increasing, that's inflation. So the higher the inflation, the less valuable the currency is, right? Because if the rate at which the prices of the goods and services in that economy are increasing, this definitely drops the currency's value. Another thing, another overview, the third overview is the employment data. That's the third one. And then the fourth one is the trade balance. So let's look at the employment data. So employment data provides information about the strength of a country's labor market. So there are like three important employment datas, right? The top three are written right here on this slide. Is number one is employment rate, number two is the non-farm payrolls, and then number three is the wage growth. Feel free to take note of these because you will see them on economic calendars, and take note of them. Number one is employment rate. Number two, take note of the non-farm payrolls. And then finally, take note of the wage growth because these indicators are part of the employment data, which is an overview of an economic indicator, all right? And then the last one we have here is trade balance. So what is trade balance, right? Trade balance, which is here, this is number four. So, what is trade balance? So, the trade balance indicates the difference between a country's exports and imports, and a trade surplus usually strengthens the country's currency, while a trade deficit usually weakens it. So, a quick way to really like break this down is try to get your local country's trade balance to understand the strength of that country's currency, right? So, but isolating them is really not a good idea. But try to look at it as an overview, right? Try to look at it as an overview because all these are dominoes, right? It's like a sequence, right? So it starts from the trade balance, then it goes to the employment data, right? So it starts from trade balance, goes to the employment data, then it goes to the inflation, then it goes to GDP. GDP being the main guy, right? Being the main one here. So again, this is an overview of economic indicators. Now, the impact of economic indicators on the Forex market. So, we have three examples here. So, the first one is the release of economic data. Okay, so these are the three the three impacts of economic indicators on the Forex market. The top three impacts of economic top three impactful economic indicators on the forex market. So the first one is the release of economic data. So most economic data are scheduled releases that occur on a regular basis. So economic data basically they should be something called the calendar of economic events, and this helps you know and anticipate market moves. And then the second impact here is strong GDP growth, right? So here it says, for example, strong GDP growth increases the demand for a country's currency as it is viewed as a sign of economic strength. Increased demand pushes up the currency value. So the GDP growth of a country shows how strong that country's currency is. And then the second example here, we have higher interest rates usually attract foreign investors seeking higher yields. This increased demand for a currency tends to raise in value. So higher interest rates, basically, this is the bond yield of the country. So each country has a certain bond, right? So and then the interest rate of that bond, if it's high enough, this attracts investors to invest in that country's interest rate bonds. Okay, and finally, after this conclusion, of course, I'm going to show you a demonstration of the rocket booster strategy on the forex market. So in conclusion, and here are the key takeaways. The forex market is a complex and exciting marketplace that is influenced by a range of factors. Economic indicators are among the most important factors as they provide valuable insights into a country's economic health and prospects. Now, by understanding these factors, traders can make informed decisions and potentially profit from the forex market. So, you really need to understand why. Now, it is very important for you to gain the strategies and the skills and the technical analysis and the market analysis, which I am going to do a demonstration right just now of the rocket booster strategy. But even as I'm showing you this strategy, please, you need to understand economic data. Very, very important for you to understand economic data. And now let's look at a demonstration of the rocket booster strategy. And one of the currency pairs, which I believe is on in a certain trend. So as you can see here, we're looking at this currency from a different view. Okay, we're looking at this currency from a different view. Okay, so Using the rocket booster strategy, the price has to be below the 50-day moving average, represented by this blue line here. That's number one. Number two, the price has to be below the 200-day moving average, represented by this red line there. That's number two. And then number three, the price should be below both moving averages. And then finally, the 50-day moving average should cross below the 200-day moving average. And as you can see, it has been trending downwards. Following, if you follow the 200-day moving average here, this is called a trend line, right? So these are trend lines. So as you can see from the trend line here, the price has actually been trending uh, downwards, and this is definitely a good position to sell. Okay, and I'm using candlestick patterns. So again, if you enjoyed this video, please rocket post it and inspire me to share more forex pairs that you can trade. So again, finally, if the 50-day moving average crosses below the 200-day moving average, that gives you a sell signal. So let me put my disclaimer. Do not buy what I tell you to buy. Do not sell what I tell you to sell. I reserve the right to be wrong about any trade. So please do your own research before you buy or sell anything. I would love to thank you so much for watching. Rocket, post this video and take care. Trade safe and bye bye.